We got a canary in the loan mine. Hey, it's Eric Osses here from Homebridge Financial Home Mortgage with my weekly update on mortgage rates, the economy, the week ending March 10th, 2023. It's jobs week, and we finally got some good news for interest rates. Last month, a surprisingly strong January jobs report shocked the markets and sent rates on an upward tear. But a closer look at the data then revealed some, in my opinion, highly suspect seasonal adjustments made to that data, making the jobs numbers appear much stronger than the raw unadjusted data suggested. It didn't matter though, rates shot higher. So we waited on pins and needles for a month for today's jobs report. And to our relief, it wasn't too bad. With February jobs up 311,000, that was against a forecast of 225,000. But what the markets really liked was the unemployment rate, which went up to 3.6% from 3.4 last month. And within those statistics, there was a large increase in duration of unemployment less than 5 weeks. The heck is that? Well, let's take a quick look at that, because that really is a statistic that talks about people that have recently lost their jobs within the last 5 weeks and are looking for new employment and they haven't found it yet. So that is a sign of some cracking in the jobs numbers, and also a sign that the economy is starting to slow down. So we're watching that very closely, and kind of piling on along with that. The Bureau of Labor Statistics, their jobs report for February also showed that the average weekly hours worked went down 34.5 from 34.6. Seems like a small number, but it's significant. Average hourly earnings are up very modestly. And if you look at what's called the JOLTS survey, we look at the leisure and hospitality sector, which has been one of the primary drivers of employment, that is starting to level off. And that means fewer newer jobs coming on the market in the coming months. So we're keeping a very, very close eye on that. These are just some cracks that are showing. Another crack appearing is in the banking sector, highlighted this week by the collapse of Silicon Valley Bank. What happened? Silicon Valley Bank is a bank that lent to many riskier tech startups with the help of a bunch of venture capital partners. Those partners became concerned about the bank's ability to cover customer deposits and started to pull money out of the bank this week, forcing the bank to sell some of its assets, mostly treasury securities, to maintain liquidity. Here's the problem. With all the Fed's recent hikes in interest rates, the value of existing Fed securities has plummeted, and they're underwater. You know, if I'm a bank and I hold securities that are paying a 2% rate, but the prevailing rate is 4%, I can't sell my 2% rates, for what I paid for them, leading to a loss. Ultimately, that led to the bank's failure. That was not good news for the overall financial markets, but the silver lining in that was a rally in the bond market, which helps mortgage rates. Bonds are considered a safe haven for investors. When things go bad, bonds benefit with what's called flight to safety investing. And as money flows into the bond market, interest rates fall. The events of this week will put into question just how aggressive the Fed will be at their next meeting, which is on March 22nd. Will they hike 0.5% as expected, or will some of these events, cause them to rethink that, especially those cracks that are starting to form in our economy? I'm sure this week the Fed will be marching out governors to make speeches. Be real curious what they have to say. For the week, the update on mortgage rates. Conventional 30-year fixed rates down 6.76%, down fair amount from last week, almost 1/4%. 15-year fixed rates 6.25%, down 0.18. 30-year fixed rate FHA and VA 6.25%, down about 0.14 from last week. And 30-year fixed rate jumbos 6.35%, down about 0.1% from last week. So all good news for interest rates as we come into next week. Moving along, inventory in our area is still tight. So where will all the listings come from? If I'm a homeowner and I'm sitting on a 3% mortgage, why would I want to sell? knowing that the mortgage on my new home will be up over 6%? That's a valid question, but there are always reasons that people will sell, regardless of interest rates. Half will sell because of good things in life: marriage, promotion, relocation, babies, dogs. The other half will sell because of bad things: job loss, death, divorce, or medical issues. We'll always see listings come from circumstances like this, but many more will come from homeowners who have no mortgage at all on their property. Currently, almost 40% of US households are free and clear with no mortgage at all. There will be listings, so just pay attention and keep your fingers crossed. As we enter the spring home buying season, there will be additional inventory coming along. It's still going to remain tight. We could see some bidding wars and things like that, for especially for those highly desirable properties, but not all. And this makes it critical, though, to be well prepared, have your fully underwritten loan approval ready to go, and a good realtor to guide you along the way and look for those opportunities. I'm always here to answer your questions and help solve those tough financial story problems, and also, of course, work on those pre-approvals. Just reach out. You can call me 206-915-3742. That's 206-915-ERIC. You can email me, Eric at ericismybanker.com. Look for me on social media. Just search Eric is my banker. Be sure to subscribe to my YouTube channel for your regular weekly updates, plus lots of other good information. That's all I've got for this week. I hope you all have a wonderful weekend. I'll talk to you next week.